Hey Crypto Tips, Kent here, coming at you from Portugal. Got a haircut for you guys? No, not really. I just got a haircut for me because it was just getting hot here in Portugal in the summer and the long hair was bugging me. But I was talking with Toby just the other day and we were chatting a lot about different products that are currently being traded when it comes to Bitcoin. And I thought I'd take a minute to just break that down a little bit because I think it gets a bit confusing. At least it confused me at first. So the first thing I want to talk about is what everybody's used to when you buy and sell Bitcoin, which is spot Bitcoin. That's what it's called. And you can tell it's spot Bitcoin because when you buy it, you can actually withdraw it and pull it off of the exchange. So that's spot Bitcoin, and it's actually people buying and selling Bitcoin that can be withdrawn, right? And then there's derivative products that are built on top of Bitcoin, and these can be futures or perpetual swaps or options. I want to break those down just briefly, and then I want to talk about something that just happened recently when 3 futures contracts expired. But I've explained spot Bitcoin. Now when I talk about perpetual swaps, what they are is they're derivative instruments. They're not actually Bitcoin that are being traded, and this is what's used typically when people are margin trading. You know, I'm sure you guys have all heard about people having their accounts wiped out or liquidated, especially on the big days. Well, people are trading primarily perpetual swaps when they're doing that. So perpetual swaps are a type of contract that is based on what the current price of Bitcoin is in the spot market. So typically, whoever is offering a perpetual swap indexes the price of Bitcoin, spot Bitcoin, across multiple exchanges and then sets the price. And what they do is when people take a long or a short position, they aggregate all the long positions or all the short positions, and if there's more shorts than longs, well, the shorts wind up having to pay the longs for their position. That's how the margin works. It gets a bit complicated, but you can simply think that when there's more shorts in the market for perpetual swap, the funding rates are negative. When there's more longs in the marketplace, the funding rates are positive. And so it's the funding rates that help to maintain the balance on that contract, and that allows the exchange offering it to stay somewhat risk neutral as they're offering this product. But it's not actually spot Bitcoin because you can't withdraw. So that's a perpetual swap, and that trades to the price of Bitcoin, but its current prices. Futures is a separate derivative product, and futures contracts are contracts that are priced out in the future, but when they expire, they'll expire at that price of Bitcoin, the spot price of Bitcoin at that point. So let me give you an example because it sounds confusing. So currently, it's the end of June. There is a July futures contract that will settle at the end of July. There's a September futures contract that will settle at the end of September. And there's a December futures contract that will settle at the end of December. People use these to sort of hedge their risk in the future. Easiest example to think of is miners, for instance. So I work in the Bitcoin mining space, and sometimes if we want to lock in the current price of Bitcoin and we know how much Bitcoin that we're going to mine, well, we can short the futures contract for that same amount. We know that we're going to have the underlying, and we can realize that price. We're basically locking in that current price. And so that can be a common strategy for Bitcoin miners to use futures contracts to sort of hedge their risk and know exactly what the revenue streams are going to be. Another strategy that's more that's also quite popular is called a delta neutral strategy. So most of the time, people are expecting the price of Bitcoin to be worth more in the future. So there's a premium on a futures contract. So a futures contract is not tied to what the current price of Bitcoin is, meaning that as people buy it up, the buying and selling pressure is going to lead to the futures price being at a different level than the current price. So if the market's really bullish, then you'll see, like for instance, the December contract may be trading 7, 8, 10, 12% above the current spot price. And so if all I care about is fiat, which isn't all that exciting here, but there are traders out there that are excited about fiat. But if I see that there's a 12% difference between the future contract and the spot price, well, I can put my capital to use by buying Bitcoin in the spot market and shorting the same amount in the futures market, because I know that 12% premium that's on that futures contract I can capture just by holding that position until it expires. So if I hold my short, if I go one Bitcoin in the spot market and I short one Bitcoin's value in the December contract, if that's got a 12% premium over time, as the futures contract gets closer to expiration, that will come down and equal the spot contract price. So people call that a delta neutral strategy, because what they're doing is there's no risk really to them. All they have to do is hold, and whatever they started that trade with is what it will be. The only thing that they've got a risk with is tying up their capital over time. So that's a delta neutral strategy, and that leads me to something that just happened last week, which was we had multiple futures contracts expiring at the same time. So we had a 6-month, a year-long, and a 3-month futures contract all expiring. And there's a lot of speculation and frankly misunderstanding as to what that means. What that meant was that people that were executing this delta neutral strategy, well, they've been holding their spot position and they've been holding their futures position at the same time. Well, as that contract expires, then people no longer, if they don't care about Bitcoin itself, they just cared about getting that premium and capturing that. Well, what it meant is that they no longer had to hold on to their spot Bitcoin. And in my opinion, that's one of the reasons why last Friday, when we had all those futures contracts expired, we saw so much selling pressure, is because people that were in that contract, they're just unwinding their positions. The futures contract was now the same price as spot. They'd captured their premium. If they weren't excited about rolling it over and trying to do the same trade in the future, well, they just turn around and sell their spot Bitcoin, because why keep it, right? So that's what was going on there. And the very last thing that I want to talk about is the infamous death cross. So the death cross, in my opinion, is something that gets quite overblown and hyped in the media. And there's a huge misunderstanding about what a death cross actually is. So people call a death cross when the 200-day moving average and the 50-day moving average cross. Well, when they cross, you have to understand that there's at least 50 days in the past for the 50-day moving average to make that happen, and 200 days in the past for the 200-day moving average, all that data to come in and make those two lines cross. Why is that important? It's because it's time that's already passed to make that cross. So it's an indication of momentum with the price, and while it can be an indicator, really for me, what matters is what happens when the price comes up and interacts with those moving averages. Oftentimes, if you look back historically, by the time the 50 and the 200-day moving average have crossed, the price has already dropped. So I'm talking about the death cross, not the golden cross, which is when they cross on the bullish side. But on the bearish side, when they cross, well, it means that the bearishness has pretty much already happened. Now, it can be an indication of weakness, so we have to wait to see what happens when the price comes back and interacts with the 200-day and the 50-day moving average to see if it's really going to reject at that point and lead to more downside. So, in my opinion, it doesn't really matter all that much because it's already happened. And what we need to see now is what happens when the price comes back to interact with either of those moving averages. That's going to give us the information we need to know. Are we going to be in a continuing bear market? Are we going to go down further or not? So anyway, those are just some educational thoughts on different products, spot, derivatives, futures. I'm not going to talk about options. Those get a lot more complicated, but they're another derivatives product. But hopefully you guys understand the difference between spot, perpetual swaps, and futures contracts now, and a little bit about the death cross. So you can always reach me on the interwebs, various social media. Hope this helps, gives you guys a little education, and yeah, stay cool out there, huh? All right, ciao.